Here's something that shocks a lot of people. You finally retire, your salary is gone, and you think, at last, no more tax. But then, the very first month your living annuity pays out, and boom, SARS takes their cut. Retirees often tell me, Hardi, I thought the taxman retired with me. Unfortunately, he doesn't.
And the reason is simple. Retirement doesn't end tax, it just changes the way it shows up. Suddenly, you've got different streams of income: annuities, dividends, interest, rental income, and capital gains. Each stream is taxed under its own set of rules. Some are efficient, some are less so, and a few can land you with nasty surprises if you don't plan.
That's why today's masterclass is so important. We're going to show you exactly what changes when you stop working, how each stream of retirement income is taxed, and 5 smart plays to keep more money in your pocket.
And once you understand how the system works, you'll see why two retirees earning the same amount can end up with very different tax bills. The difference? Smart planning.
Welcome back to the Family Wealth Retirement Masterclass. I'm Hardi Swart, certified financial planner at Family Wealth Custodians. For the past decade and a half, I've been helping thousands of retirees to retire with confidence and clarity.
And I'm Hugo Kloppers, also a financial planner with almost a decade of experience. Together, we'll share practical insights and real-life strategies to help you retire smarter.
Here's a quick reminder, this video is for educational purposes only. It doesn't constitute personal financial advice. Everyone's situation is different, so please speak to a certified financial planner before making any big financial decisions.
And if you find this useful, please like, subscribe, and hit the bell so you don't miss an episode.
So, Hugo, I think the big question facing most retirees is, what really changes according to my tax once I stop working?
That's a great question, Hardi. And the truth is, retirement doesn't mean the end of tax. What changes is the type of income you earn. Instead, you now have different streams of income: annuities, interests, dividends, rental income, even capital gains. And each stream is taxed under its own set of rules.
Exactly. And before we dive into those 5 common retirement income streams and how they're taxed, let's first take a step back, because the very first decision you face at retirement is what to do with your retirement fund, whether that's a pension fund, a provident fund, or a retirement annuity. And that's a very big question that can have massive tax implications.
Right. At retirement, you can take up to 1/3 of your retirement fund as a cash lump sum. SARS uses one lifetime tax table across all your retirement funds. The first 550,000 Rand is tax-free. After that, the tax brackets are 18, 27, and 36%.
The rest, usually 2/3 or more, must be used to buy an annuity. That's either a living annuity, where you choose the investments and your drawdown, or a guaranteed life annuity, where the insurer pays your fixed income for life.
Let's make this real. Take Clive. He retires with 9 million Rand in his company pension fund. 1/3 is 3 million Rand, and technically he can take it all as cash.
But here's the catch. SARS only gives you the first 550,000 Rand tax-free. The remaining 2,450,000 Rand gets taxed according to the retirement fund lump sum table. That pushes Clive straight into the top bracket, and his tax bill on withdrawal, according to the 2026 retirement fund lump sum tax table, will be approximately 807,750 Rand.
Now compare that to a different strategy. If Clive only takes the 550,000 Rand tax-free portion and leaves the rest to buy an annuity, he avoids that massive once-off tax hit. The balance continues to grow tax-free inside the annuity, and he only pays tax gradually as he draws an income.
That's the difference that proper planning can make. 2 options, the same fund value, but one leaves Clive with approximately 800,000 Rand less on day one. That's why it's so important to model the impact of taxes before making these big decisions.
Now that we've looked at retirement funds and lump sums, let's move on to the 5 main streams of income in retirement. For each one, we'll explain what it is, where it comes from, and give you a simple example of how it is taxed. Then we'll also show you practical ways to potentially reduce these taxes. Let's start with the biggest income for most retirees, and that is the income they draw from their retirement funds. An annuity is the income you receive from your retirement savings once you convert them at retirement. You can either choose a living annuity, where you control the investments and the drawdown, or a guaranteed life annuity, where the insurer pays you a fixed monthly income for life.
The source here is your pension fund, your provident fund, or your retirement annuity savings that you've built up over your career. When you retire, at least 2/3 of that money usually has to be converted into an annuity. So let's start by looking at a practical example. So Hugo, let's take Tandy for instance. Let's say she's age 65 and she draws approximately 40,000 Rand per month from her living annuity. That equates to 480,000 Rand per year. SARS taxes this like a salary. Based on the 2026 tax table, her tax bill after rebates will be approximately 84,600 Rand for the year. Tandy's effective tax rate sits at approximately 17.6%, which means she takes home about 32,900 Rand per month. That means she loses 7,100 Rand per month from her retirement income when she retires.
Hardi, the question a lot of retirees have is whether there are ways to reduce the tax you pay on your living annuity income in retirement.
That's a great question, Hugo, and the answer is yes. One of the most powerful tools is called disallowed contributions under Section 10C of the Income Tax Act. Here's how it works. During your working year, you can only claim a tax deduction on retirement fund contributions up to a limit of 27.5% of your taxable income, capped at 350,000 Rand per year. But many people contribute more than that, especially if they started late in life or wanted to catch up. Those extra contributions don't disappear, and that's important. They build up in what SARS calls a Section 10C pool. You might build them through regular overcontributions or even by making a large once-off payment close to retirement. The total value is reflected on your SARS profile, usually on your ITA 34, and your fund administrator issues contribution certificates confirming. When you retire and start drawing from your annuity, Section 10C allows you to use that pool to offset your taxable income until it's used up. In plain English, for as long as you still have disallowed contributions available, part or sometimes even all of your annuity income can be effectively tax-free.
Let's make it real, Hardi. Imagine Tandy had 2 million in a disallowed contribution when she retired. In her first year, she draws 480,000 Rand from her living annuity. According to Section 10C, that entire amount is offset by a disallowed contribution pool. Her taxable annuity income for the year is zero, since SARS will refund the tax amount at the end of the financial year.
And the pool carries forward. So in year two, she still has 1,520,000 Rand left, shielding her income. That means Thandi enjoys about 4 years of effectively tax-free annuity income before the pool runs out. After that, SARS starts taxing her annuity as normal income. It's also important to note that all investment returns inside a living annuity is completely tax-free. It's a hugely effective way to reduce your tax bill in the early years of retirement, and it can also play a role in estate planning if structured correctly. We covered that in one of our earlier videos in much more detail. You'll find a link in the description below. The next income stream in retirement that we're going to explore is interest earned. Interest is the return you get from cash-based investments, things like fixed deposits, saving accounts, or money market funds.
And the source could be as simple as the cash you leave in the bank or a low risk fund in your investment portfolio.
Let's use a practical example to illustrate how tax is implicated on the interest that you earn. So, Peter is age 66. He has about R1 million sitting in a money market account. At an 8% interest rate, he earns approximately 80,000 Rand for the year. Because he's over the age of 65, the first 34,500 Rand that he earns is tax free or exempt from interest tax. The remaining 45,500 is taxed at his marginal tax rate.
So, Hardi, can retirees reduce the tax they pay on interest?
Absolutely, Hugo. SARS gives you an annual interest exemption. So it's 23,800 Rand if you're under the age of 65. And the moment you go over the age of 65, the amount jumps to 34,500. The trick is to use this allowance wisely. If Peter only had around 430,000 Rand in his money market account, earning 8%, all the interest will fall within the exemption and be completely tax-free. But with larger balances, it often makes sense to move the excess into more tax-efficient vehicles. Things like a tax-free savings account, a retirement annuity or living annuity, or an endowment, so you don't pay unnecessary extra taxes. There are also ways to reduce taxes by splitting the investments between spouses, but that's something we can cover in more detail later. The next income stream is dividends. Dividends are payments companies make to their shareholders when they share the profits. If you hold, for instance, South African shares or equity funds, you'll receive local dividends.
The source could be JSE listed shares, ETFs, or local unit trusts that invest in South African companies. Let's look at a practical example. John receives 50,000 Rand in local dividends from his equity portfolio. A flat 20% dividends withholding tax is automatically deducted at source. That means SARS takes 10,000 Rand and John receives 40,000 Rand net. There's no further income tax payable on those dividends.
And here's the important point. For someone with a high marginal tax rate, dividends can actually be more tax efficient than interest or other income sources. If your marginal tax rate is above 20%, then receiving income as dividends instead of interest could save you tax. But you do need to be aware of the volatility of equities. Share prices can move up and down. So while the dividend stream may be attractive, the capital value of your investments can fluctuate. Another important source of income or income stream for retirees is capital gains. This happens when you sell an asset for more than you paid for it.
The source could be shares, unit trusts, ETFs, or even a property. And remember, the Tax Act does provide a 2 million Rand primary residence exclusion for those taxpayers who sell their primary residence, the home that they live in. This means that the first 2 million of your capital gain is exempt from tax, meaning that the most taxpayers won't actually need to pay capital gains tax on the sale of their home. It is important to know that capital gains tax doesn't apply when you sell personal use assets. So there's no need to declare the details of your bicycle sale or your washing machine to the taxman.
Let's look at a practical example. George sells his company shares for 180,000 Rand that he originally bought for 100,000 Rand. His profit or capital gains is 80,000 Rand. The first 40,000 Rand is excluded under the annual allowance. This profit or capital gain is taxed at a lower rate than normal income because only a portion of the capital gain, currently sitting at 40%, is included as taxable income and not the full profit. For George, the calculation would look as follows. 40,000 Rand times 40% equals 16,000 Rand, which is added to his taxable income and taxed at his marginal rate.
So, Hardi, can retirees reduce the tax they pay on capital gains?
Yes, Ishu, they can. And the most effective way to do this is by timing, by realizing gains gradually and making use of that 40,000 annual exclusion every year. You can often avoid or minimize capital gains tax completely. Another effective tool, especially for high income earners or retirees with significant portfolios, is to use local or offshore tax wrappers like endowments or sinking funds. Inside these vehicles, the effective capital gains tax rate is 12%, compared to up to 18% if you're in the top marginal tax bracket. For the right client, the difference can mean very real savings over time. The last major income stream for most retirees is rental income. This is what you earn from letting out a property that you own. SARS doesn't tax you on the gross rent, but only on the net profit after expenses.
Sources could include a buy to let flat, a second house, or even commercial property. And you can deduct things like levies, rates, insurance, bonds, interest, maintenance, and agent fees.
Let's look at a practical example. So, Leratu earns about 216,000 Rand a year in rental income. Her expenses are levies, rates, insurance, agent fees, bond interest, and maintenance, totaling about 150,800 Rand. That leaves a taxable rental profit of about 65,200 Rand a year, which is taxed at a marginal rate.
So, Hardi, can retirees reduce the tax bill on rental income?
Definitely, Hugo, but here it comes down to proper record keeping. Every legitimate expense must be claimed, from repairs and security costs to garden services. And here's an important thing. Remember, improvements increase your base cost, which reduces the capital gains tax when you eventually sell the property. So, Hugo, we've covered a lot today. From what really changes when you stop working to the 5 main streams of income in retirement, and the practical plays that you can use to pay less tax if managed correctly. The message is clear. Retirement doesn't mean the end of tax, but with planning, you can control how much of your hard-earned money actually ends up in your pocket.
And that's the difference between two retirees with the same income but very different outcomes. Smart planning makes the difference.
If you're interested in managing and reducing your taxes in retirement, this is one of our core specialities. Tax planning forms a critical part of our retirement master plan at Family Wealth Custodians. You can schedule a complimentary 15-minute exploration call with one of our professionals to see if we can help you. The link is in the description below.
And don't forget, you can also join our retirement community. That's where we share weekly updates, tools, and strategies designed specifically for South African retirees.
Thanks for joining us for this Retirement Masterclass. If you found it helpful, please like the video, subscribe to the channel, and share it with someone who's struggling with their taxes in retirement. Until next time, my name is Hardi Swart.
And I'm Hugo Kloppers.
This is Family Wealth. Keep investing into your future.